timely, insightful, discussion and analysis of economic trends and markets. From Southern California to Sacramento, featuring business and political leaders, unique field reports. From Orange County and the campus of Chapman University, this is the Chapman Business Report.
And welcome back to the Chapman Business Report. That's our regular look where we focus on the regional economies of Southern California and the national and international economy as well. I'm Pete Weitzner. I head up the broadcast journalism program here at Chapman University, also a longtime business journalist, not quite as long as my colleague and major domo, Essia Debe. Dr. Essia Debe has been the economist here at Chapman, and just recently, for the 35th year, delivered his revision to his economic forecast on the heels of their 35th economic forecast. And boss, we have a lot to talk about in this show pertaining to your forecast for the U.S. economy, for our region, pretty strong down here in Orange County and in Northern California. We're talking a lot about housing because 25-30% increases in home values in the last year. But we are going to talk nationally, if not internationally at first, because we record this at the end of June, and last week, many saw it coming, some didn't. The Federal Reserve, Ben Bernanke, indicating they're going to change course. And I say international because, as one banker, and many would put it the same way, he said the Fed, while it's our Fed, is the world central bank. So this comment that they are going to taper off their quantitative easing, what is your take on it?
Yeah, first, I guess we have to explain a little bit of a history, how we got here. Federal Reserve, central bank, typically what they do during recession, they lower the short-term interest rate. That's the federal funds rate. That leads
what
to
they
lower,
lend to banks at, and it's basically been zero.
Yeah, that's discount. They do discount rate, federal funds rate, prime interest rate is going to go down for businesses and consumers. Basically,
been doing it for 5 years.
They want to stimulate consumption, which is tied to credit, investment, and even export.
And they wanted to help the banks.
Exactly. That's typical. But this time around, this wasn't in textbook actually 5 years ago. About 2008, they decided to pursue what we call quantitative easing. What that is, in plain English, is printing money. So what they did about 2008, 2009, the Federal Reserve started launching their first round of quantitative easing. They printed about $1.2 trillion. Now, was that necessary? Most economists, they agree, and they say yes. And the reason was because the credit market was frozen, nobody was lending money to anybody else, and the Federal Reserve came as a last resort. They're not a depository institution, they don't have your money, my money, but they have ability to print. So they printed the money and they lend it out there.
Real quick, there's some history going back to the Great Recession.
Yeah,
they've
done it, yeah. So what they did, they bought mortgage-backed securities, long-term rates, the student loan, commercial papers, anything.
That's why we sit here and mortgage rates, even though they've tilted up, are still at historic lows.
Exactly. So they did that in 2000, 2008. They followed it by another $600 billion. So that's about $1.8 billion. Then last September, and together with December, they announced that this time around they're going to continue pursuing quantitative easing, printing money, but this time they're going to do $85 billion a month indefinitely.
Which, I'm an ex-CPA, that adds up to another trillion over the course of a year.
Exactly. And they said we're going to do that as long as unemployment rate is above 6.5% and inflation is below 2%. Now, what has happened recently, the last couple of months, there has been some disagreement among the board members that maybe this is creating a bubble. What's the bubble? Stock market is running hot. Home prices are running, that we talk about.
Right, well, let's look at the stock market. It's also proof, I suppose, that the Fed policy worked under Bernanke, the Obama administration, because he's there at the pleasure of the president. Dow Jones up 125%, S&P up 135, NASDAQ up 165.
Exactly, and home prices. We're going to talk about home prices, and those are running double digits. So what happened, some of the board members, they said, hey, maybe this is causing another bubble, maybe we should have stopped this. So all economists expected for them to say, well, maybe we're going to pare it down. Again, they're not going to stop, buying bonds and mortgages.
Not till we're at 6.5%.
Yes, but they said we're going to pare it down. As soon as they gave that indication to the market, everybody got nervous because 10-year bond were running about 1.6%. That's a 10-year rate. That is, would you lend me for 10 years at 1.6%? It was ridiculously low. It moved up to 2 before their announcement or in anticipation. And once they announced it, Today's rate, as we're
Right.
seeing it, is 2.6%. Now, is this a good policy or bad policy? I think, first of all, they're going to pare it down. They're not going to stop totally abruptly. And I think it's needed. I mean, we have to slowly go back to the normal course of economic activities. That is, the Fed should pull out of this money printing business.
Right, because many people
Now,
say it's just a Fed-fueled and cost-cutting fueled economy.
yeah, and it
And not a
creates-
demand-fueled
and-
economy.
And it creates quite a bit of inefficient decision makings. You know, people who should really invest money in productive capacity are chasing yield, doing things
Right.
that they're not supposed to do, just because the money is so cheap, and that's dangerous.
That said, GDP has been really abysmal, relatively speaking,
Yes.
for coming out of such a steep recession. Your forecast is 2.7% for next year, 2014. I think the Fed now sees a little more
Actually,
than that.
3%. Yeah,
Right.
yeah.
So you might take a little issue.
Yeah,
Maybe they're
yeah,
being a little
yeah,
rosy.
yeah.
So given that, why taper off? Typical out of a steep recession is 4.5% growth.
Yeah, but they should taper off, because whatever benefit we got from this quantitative easing, it was really that first two round that I mentioned, the 1.2 and 600, because the credit market was frozen. Anything more that we are doing, artificially keeping rates down, let's say you're investors. What would you do when money is so cheap? You chase yield, high yielding,
Right.
assets. Could be stock market, could be even dumping it in real estate market. We're artificially supporting these markets just because the rates are low. We have to stop that money printing business.
Sure.
Let the rate goes to where it should be. And by the way, I don't think the 10-year rates is going to go to 5% or 4%, because the economy is still weak. Unemployment is still
So
too
you don't
high.
think then mortgage rates will go to 5%?
5 or 5.5%. I don't see it. There's no reason
That
for it
that
to
would
go.
really crimp real estate, which we'll get to in a bit.
Let's go to the normal direction. That is a little bit of uptick, and then decision making becomes more wiser and reasonable. So I'm all for it, but I agree. If they cut totally 85 billion, let's say tomorrow, they say we don't do it, the rates can shoot up higher, because everybody tries to dump the assets that they bought at 1.5%, 2%, because they don't want to get losses on their principal.
Sure.
So that would be dangerous.
Well, let's get out of the Fed. Just a couple of quick wrap-up questions. Some folks say, these would be folks maybe on the political or economic left, that this Fed policy benefited just the big fella. It benefited banks, benefited Wall Street, benefited large corporations, hurt small business.
Yes, to some extent that's true, because see, small businesses, they brought the rates down, right? But still, they're putting quite a bit of pressure on banks to lend. I mean, most people say, why banks are not lending? Banks, they would love to lend, especially small banks. But regulators constantly are putting pressure on them. They're sitting back there and say, you can't do this, you can't do that. So small businesses didn't really, and even consumers are still getting a mortgage. Is quite difficult. It's not as easy. But who benefited? That cheap money that went to the large banking systems. I don't want to name any of these banks. That they can do all kind of things. Carry trades, complicated. Investing in commodities,
We all
arbitrage.
sort of bought Bank America
Yeah.
and all those types.
So it is true. Wall Street and large bankers are the main beneficiaries. That doesn't mean it's not
Right.
helping us. I mean, I refinance more mortgage, but
Can you
but-
say at this
but the
point, what's
effect of it
the
is
final
minimal.
question, what the Bernanke legacy will be then? Because his legacy is this.
No, not necessarily. I think he did a very good job during deep recession and financial crisis of 08, 09. But now this extra stuff that he did in latter part of his governorship, I think that was a little going too far. And I guess he wants to clean it up before he leaves, which it seems like he's leaving in January. But overall, he's been a good Fed chairman.